Let's talk some earnings, do a little bit of trading. Tom White here with me as we look at DICK's Sporting Goods after earnings down about 1%. Joining us, Seth Basham is Managing Director at Wedbush Securities and equity research experts covering the consumer group. Seth, good morning. DICK's was on a pretty great run coming into this year. Now this weakness adds on to a pullback since January. What do you make of that?
I make of it that the market is seeing signs of uncertainty, especially around consumer discretionary spending, and DICK's is getting wrapped up in that. Now, this company is performing better than almost any other hardlines retailer there is. 6% comps is just outstanding in this market environment, and we think the company is being disciplined with its spending and its guidance, and that's why we're looking at a stock here that's flat to down, and investors are digesting the news and seeing how much upside there is to the company's guidance going forward as some of these macro uncertainties get settled out.
It seems like the high end of their range for comps still gets past the estimate when they're saying they could get up to 3% fiscal year comp sales, but as low as 1%. Is it just the range, I guess, that shouldn't be that wide?
It's not necessarily the range. Certainly the midpoint of the comp guidance is below consensus forecast. And the EPS guidance is below consensus, even at the high end. So I think there's concern around their ability to drive earnings growth going forward as they lean into some of their investments. But from our perspective, there's a lot of discretion with those investments. The company is guiding to gross margins increasing 75 basis points in 2025. That's far ahead of consensus expectations. And essentially, it means that they can take those gross profit dollars and take them to the bottom line if they want to, or reinvest them in the business for long-term growth. And they have the ability to delay some of those investments if necessary to manage the earnings. So it creates a very conservative earnings setup for 2025, as long as the macro doesn't just deteriorate beyond belief.
Okay. So that's a pretty strong wording there, as long as it doesn't deteriorate beyond belief. So what's the big driver for them that could swing that guidance in either direction? Like, what's the item or the part of the store that's like super tariff dependent or whatever?
Yeah, incredibly, tariffs are more limited for this sector than they are for a number of other hardline sectors, because when you're selling apparel and footwear, a lot of the sourcing for that has been shifted out of China to other places in Southeast Asia, like Vietnam. So you have some exposure there, a little bit of exposure on the hardline side of their business, but it's more limited than companies like a Floor and Decor or even the furniture retailers. So we think tariffs are definitely a swing factor, and more importantly, the knock-on effects from tariffs on the broader consumer spending backdrop could limit discretionary spending. However, again, for this category, and for this company specifically, it's a little bit less discretionary than some of the other categories like furniture, and their customer base is skewed more premium than others in the sporting goods retail market. So they should be better positioned than others.
Okay. Your price target's pretty close to where we're at, so you're still on neutral, right? What about some of the shareholder-friendly stuff that they're doing with the buyback and dividend too, right? I mean, does that draw anyone into the stock that maybe otherwise hadn't been?
I think it's the incremental positive. I'm not sure if it's a key driver. Certainly some long-only funds will be looking at those positives. I think a nice yield looks attractive, and the fact that they can continue to buy back stock if they want to. So I think those are incremental positives. But I think most importantly, it's the earnings power and the long-term growth story here.
Okay. Thank you, Seth. Appreciate the analysis. Tom, we got a $250 price target from Seth and his team. So what do we do with that?
Yeah,
neutral?
I think the pullback that you've seen in the stock, about the 20% bear market. Remember, this has got a really small float. I think only about 81 million shares outstanding. So this is a tough one to trade, right? There's not a lot of depth and liquidity in these markets. Are really wide. Implied volatility has been crushed. I'm surprised the stock's not down more, but their comps were great on this report, and EPS. for fiscal year 2025, they actually lowered a little bit. So I looked at a strategy that, you know what, maybe the stock can stay here. Maybe it can go a little bit higher and I can still profit on this. And if it goes lower, I can profit. So I looked at selling an upside call vertical here, going out to the April 4th weekly cycle. So just about 3.5 weeks till expiration on this one, where I'm going to sell one of the 220 strike calls, then buy one of the 230 strike calls. So short $10 wide, neutral to bearish call vertical. You're collecting roughly about a $3 credit. That's what you can make on this trade. It takes your break even up to 223. That's about 5% above the current share price in there. So you do have that cushion to the upside. It's a little bit constructive, a little bit conservative, where you think, okay, this stock's had a great run over the last year. But at the same time, maybe there's going to be some headwinds. We've seen the consumer sentiment confidence numbers. People are pulling back on their spending. You saw the airlines earlier getting hit on some of this data that they're providing. So if you think this stock's going to maybe consolidate, it can still go a little bit higher and you can profit. But if you think it's maybe done running at this point, this trade takes advantage of that.
All right. So basically a neutral approach, looking for a range for it to hold in,
right.
Which seems reasonable given the chart and given Seth's analysis and where it's traded a lot the last year, which has basically been at like $210.
Right.
You got a trade in Home Depot as well.
Yep.
Another retail trade for us, one that's broken down a little bit more heavily on the chart, but you're going to do a little dip buying?
Yeah, correction territory on this one. I think maybe if you're looking at this thing rebounds, it's down about 15% from those all-time highs that we saw just in November, and it's been flat over the last year. So if you think this thing's going to maybe re-accelerate, got interest rates coming down, that's going to help people maybe redoing their homes and maybe taking on more projects as we get into the spring selling season here. So I looked at something where I can offset some of my costs, taking a bullish stance, but I'm giving myself a little bit of duration. I went out to the April monthly strike or option series here. That's about 37 days to expiration here, where I'm going to buy an unbalanced or broken wing call butterfly, where I can offset some of my risks on this bullish take here. Going out to the April 17th options, buy one of the 370 strike calls, just slightly in the money. Sell two of the 390 strike calls, and then buy one of the 395 strike calls. So in essence, you're buying a bullish $20 wide call vertical in this strategy, offsetting some of the cost by selling that $5 wide one with the same common strike at the 390. That's where you want it to go. If you pay a debit of about $750 for this unbalanced call butterfly, it takes your break even up to $377.50 over the next 37 days. That's only about 1.5% above the current share price. So you don't need a monster move to get above that break even. Anything above that's going to be profitability. Even if it goes above the 395 strike, it's still going to be a double in profitability on this one. So if you want to offset some costs, if you think this thing's going to grind higher over the next 5 weeks, this takes advantage of it.
Okay. So bullish into Home Depot, not quite for the Dick's trade.
Yeah.
Okay. Thanks, Tom. All right. Like the approach into some retail stories. The retail bag's kind of mixed. There's some interesting trades in there. I can see that.